All right, welcome to another great educational webinar here at Advanta IRA. Today we are going to be talking kind of about the outlook for gold and silver for 2026. If you've been watching the news and paying attention lately, the precious metals market has been a hot topic. And so we're really happy today to have a great guest speaker on. We've had Greg on before, happy to have him on again to talk about really what the rest of 2026 might look like. So as we go through the presentation today, if you have any questions, type those into the Q&A box on your screen. We'll be happy to get to those questions, either of myself or Greg, that you have for us. So please, if you're listening live, type those questions in. If you are listening to the recorded version, you can certainly contact me. My contact information is here on this slide. My name is Scott Maurer. I'm the Vice President of Sales here at Advanta IRA. I've been with the company for almost 20 years now. I'm a licensed attorney in the state of Florida, although I do not do any legal work for Advanta clients. But yeah, if you have any questions on IRAs, self-directed IRAs, the different investment options, or how you can make gold and silver part of your portfolio, please reach out to me. My phone number is there and my email as well. Just a quick disclaimer, anytime we do any events, especially our webinars, Advanta IRA want to make sure we are not providing, and make sure you know that we do not provide investment advice. We don't endorse any particular products. The webinars that we do are for educational purposes only, and our speaker today is got a wealth of information on that front. If you do need some legal assistance, some tax assistance, let us know. We're happy to provide you with those outside contacts, but note that we can't provide that type of advice for you. Just a little bit about our company. We've been around for over 20 years. We have close to $4 billion in assets under custody here at Advanta Trust Company. And we really dedicate ourselves to the clients with our personal touch, our concierge level service, where you get assigned to a specific person, a specific contact here at Advanta IRA. You're not calling an 800 number if you need something regarding your account. So our guest speaker today is Greg Allen with Allenhouse Metals. He's been on with us many times before to talk about the state of the market, and right now is just an excellent time to have Greg on. Again, the markets have been, like I said, all over the news lately, financial news, making the regular news, probably all online as well, with what's going on in gold and silver. So we're happy to connect with Greg again today, have him speak with us. And again, if you have questions as we go along, please type those into the Q&A box on your screen. You can certainly connect with Greg. His website is there, and I'm sure he's going to share some more information as well. But Greg, it's great to have you on today.
Awesome. Thanks for having us, Scott. We love coming on for these events. And as you were saying, there's a lot to talk about right now. So I'm glad we're kind of hitting this at the start of the year as well, because there's a lot of changes happening right now in the market. Just before we kind of kick off, and I just want to hit into this because throughout the presentation, we're going to talk a lot about what moves the metals markets, where do we see those markets going this year and potentially next year, but not a ton about products. And so I just want to, right off the top, before we dive into things, one thing everybody needs to know is not all metals products are admissible into an IRA. Typically, when you come to a dealer like ourselves, we are easily able to advise you on what's allowed and what's not. First things first, no collectibles of any kind. If you see proof or you see any type of graded coin, stay away because it's not admissible according to the IRS. Aside from that, my biggest piece to advice on everyone, once you make that decision to, get involved in the metals market, is please, please, please avoid coins if you can. Typically where people run into trouble in this industry is overpaying for overpriced coins. You're buying metal. You want to buy metal for the weight of it. You want to buy something that holds value. The best option for that is bullion. And we typically specialize in what's called investor bars. So all of these bars, these range 1 ounce, 10 ounce, kilogram bars of gold, silver, platinum, and palladium. The big thing about these bars is we're dealing in bars that are all government approved. All of these bars have a serial number and a hologram on them, so they're able to be identified. And I think that's the big thing. One of three things I'd like everyone to take away from this today is when you're looking to get involved in metals, deal with bullion and stay away from coins. If you want to collect, no problem with that whatsoever, right? But what you're doing through your IRA is an investing, and your number one objective in investing should be, making money at the end of the day, to be quite frank about it, right? And so you shouldn't be paying these overpriced premiums for coins is all. So
yeah, Greg,
moving on.
just if I interrupt, that's a great point. And I appreciate you bringing that up, because it is very important that you understand, like, the metals you can buy personally are not always the same metals you can buy through an IRA, and you want to work with a company, whether it's Greg or someone else, that understands the difference between those two. So, in fact, someone just said I was told gold eagles are allowed. Yes, they are, but I think you have to be careful exactly what type of gold eagle. Correct?
Yeah. So, Rudy, you're 100% correct. And there's nothing wrong with a gold eagle, right? The big thing would be if you see the word proof tied to a gold eagle, that's a collectible. If you see the letters MS69, MS70, that's a collectible. So what I'm trying to say is you don't want to pay more for a graded or collectible version. You're absolutely allowed to buy an eagle. The shocking fact and I see you're talking about saints and coronets as well, it's a fineness measure. And so believe it or not, typically in fineness, you're required to have at minimum 999, 39 pure, right? The funny thing that most people don't know about an eagle is much less fine. You're looking in 94 to 96% gold, not 99.99%. So when you buy bullion for less than an eagle, you're actually getting more gold or more silver weight for what you're paying for. But if eagles, saints, coronets, if those are the things you're looking at, you're not going to run astray. I would just be careful again with what exactly you're getting. Avoid the collectibles. And just because I see this here, I'll pull it up right now before we get into it. A silver American eagle purity level is currently, for the 2026 year, they are showing at 3/9, you have 0.07% copper. And so when you actually take an assay report, it comes in less than 3/9. But moving on from the product talk, the big thing for us, our core values, transparency, convenience, and integrity, our big thing is there is no one-stop-fits-all approach, right? And so we really want to let your investment objectives guide us in our recommendations, right? At the end of the day, diversification is the key to success in anything, right? You wouldn't put all your eggs in any basket, right? And so the allocation of gold or silver, all of one or a mix of the two, is going to depend based on your investment objectives. And we're going to let that guide us throughout this process. Now, moving on, we have a service provider we work exclusively with. They're called Gage. Gage has been in business since 1976. They're the authorized purchaser for not only the United States Mint, but the Royal Canadian Mint, the South African Mint, the Australian Mint, virtually every government mint around the world. Okay. What that means is that they are authorized to purchase and distribute. They import roughly about $1.5 billion worth of gold and silver every single month. They do not sell to the public. They then distribute this through a select number of dealers like myself, as well as to banks, hedge funds, and other institutions. They are the best name in metals, which is why we work with them. They're located in Dallas, Texas. Okay. Now, moving on, if you choose to buy metal in an IRA, it has to remain within an accredited facility, a depository. Now, to my knowledge, I believe Advanta works with 8 or more depositories, and we're happy to work with any depository should you choose. The one that I'm recommending up above here is IDS Texas. IDS Texas is a wholly owned subsidiary of Dillon Gage. It's actually located in the same building as our distribution facility in Dallas. They have another location in Delaware. Personally, the reason we recommend that people use IDS Texas is due to the fact it's in the same building as a distribution facility. It makes transaction times as short as possible. When you want to buy, when you want to sell, there's no shipping. It's an audit process and it moves in and then it moves out. The fact of the matter here is, again, it's got all risk insurance from Lloyd's of London, best name in insurance. And in addition to that, you'll see it's COMEX approved, it's ICE approved, it holds LBMA accreditations. It has every certification you could want in a depository. Now, moving on.
Greg, if you can, someone had a quick question. I just want to address it because they mentioned IDS Texas, but they were talking about, my gold and silver is all Eagles that Advanta has in my IRA. Did the people I trusted to buy and start knowledgeable what to buy for me, it's stored at IDS of Texas. I think to answer your question, Ricardo, first of all, there are certainly gold and silver Eagles that you can purchase within an IRA account. Greg just was saying make sure they're not proof or some type of collectible American or silver Eagles. But Greg, do you know if IDS Texas, with the accounts established there in the IRA, they kind of scan those coins before they come in to make sure they're IRA eligible?
So IDS Texas does a full audit whenever anything is put into the vault and when it comes out. And when they do that audit, they are making sure that what you're paying for is exactly what you were billed for. So they're going to make sure that, in fact, they are real, Eagles. They're going to make sure that those have been tested for the purity. They're going to make sure as well that there's no funny business. They're not a graded product. They're not anything other than what you bought, right? And so working with them, part of the security in that is that they do a full spot audit when they're putting the metal in. They do a full one when it's coming out. And every week, they do multiple audits inside the vault. The other thing about IDS Texas that we particularly like is they only do segregated storage. For me personally, I like the idea of having my metals segregated, and packaged and vaulted away for myself, as opposed to being commingled with everyone else. So 100% that's what they're doing. Now, as far as precious metals, right? When we look at precious metals, most people look at them as a true safe haven, right? As a safety measure. What we've been seeing here over the last few years, people are now looking at this as a regular part of their portfolio because of the performance that we've seen. But effectively, a lot of people will refer to gold and silver as an insurance policy, right? The big reason for that is they are an inverse dollar trade, okay? What this means is that as the dollar loses value, they gain value. As the dollar gains value, they lose value. And so when paper markets plunge and the dollar typically dips and you have turmoil, whether it be economically or geopolitically, precious metals typically soar in price during those times. Now, when we look at it, gold, again, it's the most popular safe haven asset. It's referred to as the ultimate crisis commodity. Why is that? Well, it's because anytime there's any type of geopolitical instability, any type of economic turmoil or uncertainty, the first move the central banks make and that the big banks make is gold. Silver then follows gold. And so moving on, just to expand on this, one thing, they're value holding investments. What does that mean? Because they're an anti-dollar trade, they are guaranteed to hold their intrinsic value. They rise in value with the cost of living over time, meaning the worst case that you should see in gold and silver is they should match inflation, right? The other thing that you'll see in here is gold, silver, platinum, and palladium. There's no credit risk. There's no issuer risk whatsoever. We have clients all the time. We actually have Advanta clients that have used their precious metals holdings to secure a real estate loan, a mortgage, right? These are things that you can do with your metals because they face no credit risk whatsoever. And in addition, by definition, anything from ETFs, futures, options, stocks, mutual funds, by definition, have more risk. Now, moving on to this, I just wanted to show this as an explanation of what I mean by them following inflation and rising with the cost of living. If you look at this, in 1971, if you wanted to go buy a brand new Corvette off the floor, it would be about $5,500. The same amount of money at the time would have bought you 135 ounces of gold or well over 3,000 ounces of silver. Okay. Now, if we fast forward to 2020, that $5,500 car is now almost $68,000. But instead of taking 135 ounces of gold, it would only take 38 ounces of gold. And instead of taking 3,600 ounces of silver, it would only take 3,300 ounces of silver. And just to expand this one further to show how much has changed over the last 5-6 years, if you were to buy that same Corvette today, instead of 68,000, it would now be 76,000. So it's got an additional $8,000 more expensive. But now instead of 38 ounces of gold, it would only cost 14.75 ounces of gold. And instead of 3,300 ounces of silver, it would only be 872 ounces of silver. And so what I want to demonstrate from this is not only do gold and silver pace inflation, they beat inflation significantly. Because what you can tell is that we've reduced the amount of gold required by almost 90% to buy this vehicle. And at the same time, we've reduced the amount of silver by almost 80% that's required. Moving on, and this is one thing I wanted to illustrate for everyone here. Obviously, gold and silver have become a lot more mainstream in the last year, right? If we look back pre-2020, this was not something the majority of investors were doing. Investopedia in 2019 stated that on average, 19% of accredited investors were investing in precious metals as a diversification strategy. By 2024, Investopedia said that that had grown to 33% of accredited investors. Today, you're looking upwards of 50% of accredited investors are diversifying within physical metals. And I wanted to show the market cap because sometimes I think people forget the actual size of these markets. When we look at gold and silver together, this is over a $41 trillion market cap. It is a massive market, the majority of that being the gold market, but by no means is this some, small, fickle, manipulated market. This is a large market. Now, moving on, I wanted to get into this as we were talking about the dollar and gold and silver being an inverse trade to the dollar. When you're looking at purchasing metals and you're wondering to yourself, what causes them to go up and down? We already said it's the dollar, but how can you track what's going on? The best thing you can do is to track the forward guidance from the Federal Open Markets Committee, the Fed. They give forward guidance on their monetary policy as to what they expect to do over the next quarter, the next year, and the next 4 years. They telegraph every move that they're going to make so that specifically the institutional investors can tailor their investments to what's coming with monetary policy. So we look at the Fed's forward guidance as a way to see what's happening with the dollar so we can allocate our precious metals position correctly. Now, the reason I have this slide up right now, currently we have Jerome Powell as Fed chair. He was appointed by Trump in Trump's first term. Powell is out in May. Okay. Kevin Warsh is the new appointee to be the new chairman of the Fed. And one big thing that I want to emphasize here is Trump, during his interview process for this, a key condition for him was that whoever he's appointing to the Federal Reserve must be on the same program of getting rates below 2% as quickly as humanly possible without absolutely riling up markets. Okay. Kevin Warsh has a serious resume. This is a gentleman who, in the early 2000s, was an emerging executive director for Morgan Stanley. After Morgan Stanley, Warsh actually was the lead economic advisor to Bush. And during the 2008 financial crisis, not only was Warsh a director on the Federal Markets, Open Markets Committee, but in addition to that, he was the liaison for the central bank to Wall Street as well as the G20. Okay. He's widely described as Schumpeterian, which the big thing they're saying in this, he has a dislike for central banks trying to micromanage the financial economy. His overall approach is to let markets shake out their anomalies. And so the main takeaway here is everyone has seen in the news, Trump's done everything he can to get Powell to cut rates quicker than he has, right? And it has not worked. And so the key switch here is Warsh is fully on board with cutting rates quickly and letting markets resolve themselves. The overall approach to this administration is the idea that if they reduce the price of the commodities, rather the things that we buy every day, groceries, oil, these types of things and services, while at the same time reducing rates to make cost of borrowing lower and increase growth. While yes, you will have a soaring of assets because the value of the dollar will come down. Assets like gold and silver will explode in price. It won't be affecting you and I as an inflationary basis because everything we buy on a day-to-day basis is getting cheaper. That's their overall idea here. And so the big headline that you'll see is Trump has told Warsh he can produce a 15% GDP compared to the current 2% target growth. The big thing is he's taking the chains off Warsh to say, you can cut rates, do not allow the CPI reports to deter you. And this is all coming down to the fact of refinancing the debt that we're currently refinancing and the cost of borrowing. The housing report that just came out today shows housing purchases are down by 8.4%. It's no shocker. Look at where mortgage rates are. Even though the base rate's at 3.5%, mortgage rates are still well above 6%. And so moving on to the next slide, this tool here, and I want to emphasize this to absolutely everyone. I think everyone should Google this. You can use it yourself and you don't have to take my word for it. It's called the CME Fed Watch tool. What they do for every meeting in a year, they price out the statistical chance of rate cuts, rate hikes, or rates staying the same. And they publish it as a percentage chance. This is as surveyed from decision makers and economists. What you're going to notice in this slide right now, the economic data that's come out this week, in all the analysts' view, has nixed the possibility of a rate cut before Powell's term ending. If Powell is to stay true to what he's done so far, and he seems to have always stayed the same course, he will not be cutting. So Powell's out in May. The first meeting with Warsh is going to be in June. Right now, the specific forecast is for a cut in June and a cut in December. However, as time goes on, analysts believe that with Warsh coming in, we could see potentially double the amount of cuts that are currently forecasted. And that is the variable here we don't know. The key thing I want to emphasize here, and what you'll see, this chart here is showing a 57% plus chance of 2 to 3 rate cuts within the year. Okay. Now, how rate cuts are going to affect gold and silver is real simple. We're going to look at the next slide here to show. This is a chart of the US dollar. This chart goes back almost 10 years. Okay. What I want to emphasize, if you look in the center line of this chart in 2020, you can see the peak of the dollar here, pretty much around the time the pandemic was declared. And if everyone remembers, immediately following the declaration of the pandemic, we had rates slashed down to 0. So if you look here, the value of the dollar came all the way down to a bottom of around 89 on the index when we saw rates cut to 0. Now, that preceded inflation. If you guys remember, we had 9.1% inflation. Powell said it was transitory for months and months and months until they had to begin raising rates. And now you'll see, instead of rates going to 2.5%, which is where they were before, that kept the dollar just above 100, rates went to 5.5%. So what you're seeing is from 5.5%, the dollar goes from 89 up to a high at almost 115. Okay. Following the high at 115, Powell in December announced that we had reached our terminal rate, meaning they were not going to raise rates any more than they already had. And the dollar began to fall precipitously. If you see from that point until now, the dollar fell from 115 to where it's sitting today in the mid to high 90s. Okay. The move from 115 to the mid to the high 90s brought gold from $2,000 up to $5,000. It brought silver from $18 at the bottom when we had 115 all the way up to $121, which was the high that we saw last month. So effectively, what I'm trying to show here is with rates cut, yields fall, the dollar on the index falls. When the dollar on the index falls, gold and silver goes up. Real simple. Now, moving on to the next dollar chart I have here, I really wanted to orchestrate an example for everyone of what's happening short term, because the dollar's in a precarious position right now. You can see a steady level of consolidation here across the chart. Over specifically the last 8 months, we've been in the same range. The key point to note is that we're hitting lower highs and lower lows. And if you look in the right-hand corner here, I'm hovering my mouse across it. I don't think you guys can see, but if you look in the right-hand corner, there's a red line that goes from the top left to the bottom right, and there's a blue line that swoops and goes from the top left to the bottom right. And what you'll notice is that that blue line, the 50-day moving average, crossed down below the red line, the 200-day moving average. What that is called is a death cross. That is one of the most bearish signals you can see in any market, okay? And the reason that I emphasize that, that's not just the dollar, that's not gold and silver, that's any market where you see those moving averages cross. And so the big thing I want to emphasize here, we've seen a death cross in the dollar, meaning we know that's a bearish signal. We know we have an accommodative policymaker, a Morse coming in, and we know that we may have to wait a few months, but we have a situation where rates are coming down. And so the big thing that this signifies is that this actually is a great buying opportunity for gold and silver, because we have the dollar in a phase where it's about to resume its decline. We've gone from 115 to the high 90s. This decline with rate cuts here should ultimately take us back to 89. And after 89, there is potential to fall to where we've been several times since 2000, which is 72. Now, what happens to gold and silver in a rate cutting cycle? This chart right here is showing the average growth in gold during a cycle where we see rates slash to zero. In a cycle where we see rates slash to zero, the average growth in gold over the last 26 years is 145%. Okay. Looking at the same metric here on the next chart for silver, this again is showing the three major rate cutting cycles. The average return, excuse me, is 413% in silver during a rate cutting cycle. If we look at the most recent one, post-COVID, we saw 250% in less than 15 months in a rate cutting cycle there. Now, this is something I wanted to highlight here because we have, and actually, Scott, maybe we should, I just saw a question about rate cuts with quantitative tightening here. I just want to hit before I go.
Yeah, I saw that question. I don't know if that was, if that was the right time to ask that. Yeah, someone said, what do we expect with rate cuts with quantitative tightening, I guess, as opposed to quantitative easing? So yeah, if you want to address that, and then we can then we'll continue on.
Yeah, no, and Stephen, I appreciate you asking the question because that's a fantastic question. One thing, and I'm just actually going to scroll back a couple slides here to pull this up on Warsh. One other thing that's huge with Warsh is Warsh wants to unwind the balance sheet. He is an absolute enemy of carrying a large balance sheet, as we've seen before. He previously served over 6 years as a governor of the Fed from, I believe, 2006 to 2012. And basically what this is saying is he wants to start selling the assets that they've been buying, right? Effectively, right now, the estimates are the Fed holds somewhere in the neighborhood of $7 trillion. I know that they're currently buying $40 billion a month. He is not going to be a buyer. He's not going to be increasing the balance sheet. He's very much so going to be shrinking the balance sheet with runoff, rather selling or letting expire the treasuries that they own. The fact of the matter here is we expect overall between his dual approach, we think that he's going to follow a strict dual mandate, right? Employment and inflation. But additionally, we expect him to be much less concerned about the dollar specifically. The overall reason that Warsh is getting appointed and they're making these moves is because there's $9 trillion in debt being refinanced. Currently, that means they need to sell $10 trillion in treasuries to finance that. And all of that is happening while treasury purchases are at an all-time low. China currently has sold treasuries for 10 months in a row. They hold the least amount of treasuries that they've held since 2008 with the financial crisis. And so ultimately, what is shifting around the world is we're going through a shift back to mercantile banking. Okay. It's the first time in 30 years since 1996 that central banks around the world hold and are purchasing more gold than they are U.S. treasuries. The central point and the central reason to all of this dates back, I'm not going to get into anything politically, but several years ago when Russia invaded Ukraine, we kicked the Russians out of the SWIFT system. That sent cold shivers down the spines of everyone in the Eastern Bloc. And so what's fundamentally changed is that these countries previously bought treasuries not only to hold spare assets in, they bought treasuries to pay for oil. They would trade treasuries for oil because that's all you could pay for oil in was USD. What's changed is since the Russians were kicked out of the SWIFT system, we had BRICS formed. In addition to that, these countries around the world no longer require treasuries to buy oil. China currently buys oil with either gold or yuan. Russia buys with rubles or silver. We have India paying in rupees. We have Japan paying in yen. And so the big thing that we're seeing is de-dollarization around the world and an increase in the purchases and store of gold by central banks. For 4 years in a row now, China has bought 1 in every 4 ounces that has been minted in the entire world, 25% of supply. So that's extremely significant. Now, I wanted to move on here to this slide here. And the reason that I wanted to show this is primarily to show the commodity super cycle we're in right now. It is not just gold and silver that are going up, it's commodities at large. We're in a broader commodity market boom. We've had 2 of these super cycles before. We had the stagflation crisis from 71 to 80 with the end of the Bretton Woods monetary system. That saw commodities in general, from valley to peak, surge 792% in 9 years. We saw the 2000s, most people would state 03 to 11. That saw 660% from valley to peak. Currently, with what we're looking at now, we're about halfway there in this cycle. And so the big thing that I would emphasize, and I emphasize this because with increased prices and all-time highs, we get a lot of people that ask, well, where's the top? Is it at the top? Is it going to come back like it came in 2011 and 1980? And the big thing I want to show is, so long as we have an interest rate cutting cycle, and really it's a cheap money administration. That's what this is. As long as that administration is in here, gold and silver are in business and they're going to be the top performers of any market. Now, moving on here, I wanted to show total performance last year. If we look at gold, we saw 65.39% in 2025. We saw 160% of silver. We saw 18% in the S&P, and we actually saw a loss of 7.5% in Bitcoin. Okay, and the fact of the matter is here, and I will show this in coming slides. Part of the reason we saw silver perform so much more than gold is not anything unique to do with silver. It was the closing of the gold to silver ratio. This is something, if you go back and look at our past webinars, and I know, Scott, you can attest to this, we talk about the gold to silver ratio every presentation, and we talk about specifically how that dictates what we buy. Silver, do we buy gold? This type of thing. And so I think overall, the big thing is up until fairly recently, silver has been incredibly undervalued when compared to gold. I'm just seeing Alan's question with going back to the gold standard, e.g. pre-71 Nixon. I do not, I would love it if they did. I don't think we're headed that way. I think overall, the big thing we need to remember is the gold standard ended in 33. The gold exchange system, which is different, it's slightly different. This is dealing in technicalities, but Bretton Woods was a gold exchange system that existed from 1933 to 71. What it did was worldwide, it set gold at a standard price, right? It was increased several times, but we went 30, 31, 32, 35, and then eventually 38. But the price increases didn't really come till the late 60s, early 70s. What it meant was not that necessarily your currency was backed by gold, but it meant you had a set peg for gold. Anywhere in the world you were, you could take US dollars and exchange them for gold. The reason that ended was because of the fact that there were more dollars in circulation than could be exchanged for gold. First off, we got to that point. The second thing is the whole end of the Bretton Woods system in 71 is referred to as the Nixon Shoku, which is Japanese for shock. The reason it's referred to as the Shoku is because Nixon was absolutely fed up with other countries manipulating their currency to get more favorable trade deals with the US. Sounds kind of familiar to the guy who's in there right now. But the reason he ended it was the Japanese manipulated the yen. And so Nixon said, enough. We're not doing trade agreements like this, and he ended it. Now, moving on to the next, I wanted to use this slide to emphasize to people the difference between investing in physical bullion and investing in ETFs. There's different products for different people, right? The number one thing that I would emphasize is the prospectuses changed 4 or 5 years ago now, actually in 21 on SLV GLD. And that fundamentally changed the way that those funds track the price of gold and silver. They're no longer required by law to back purchases of the fund with purchases of physical metal like they were before. In addition to that, they're able to liquidate the fund at any time without investor approval and give you liquidation value. It was changed, if you look back to SLV specifically, it was changed on page 6 or 7, I believe, in 2021. What this has caused is not only do they not buy the same allocation they used to back the fund, they actually, to reduce their overhead, started selling metal that the fund owns. And so the fund now, not saying it doesn't track as close to silver, it doesn't, but effectively it is moved by volume and purchases of units more so than it is moved by the price of gold and silver. And so with basic ETFs, you'll see these silver and gold ETFs. This is December 31st of 25 until January 31st. Gold performed over 13%. Silver bullion performed over 18, almost 19%. And if we look at it, silver ETFs were down over 4%. Gold ETFs were only up 1.8. Real clear from here to see what's earning better for you there. Now, also, I see, Stephen, that's a good question just in terms of impact on industrial demand. Silver specifically is the industrial metal of choice. 60% of silver demand is industrial, related to solar, actually. And the big thing here is silver has had 100 million ounce supply deficit for 3 years in a row now. Silver's not just going up because the dollar is being devalued. Silver's also going up because we have less of it than we have for gold. One major thing with silver people don't know is silver is not typically explored for. It comes as a byproduct of finding other metals, gold, platinum, these types of things. And so when we look at it, the only thing I would consider, Stephen, with silver is we also have to think as silver gets more expensive, what potentially does that do to the demand? Does it drive more demand for other base metals like a copper, for instance, because it's eating away at profit margins? The big thing I would say, regardless of that, any of the green energy initiatives, any electronics, anything like data centers, circuit boards, all that stuff, primarily silver. Gold's demand is going to be primarily actually investment. 25% of global gold demand is just China's central bank. That's it. The thing with gold and industrial application, to give you an idea, the gold wiring these companies use, it's very diluted as opposed to the silver that they use. So industrial demand plays less of a factor. To give you an idea, these chip companies and the data centers, the gold wiring they use, depending on the gauge, 1 gram of gold produces 227 meters of the wiring. It's almost 900 feet. So industrial demand is much less important when it comes to gold. Now, moving forward here, we're looking at the gold projections. Now, big thing here with gold projections, we're looking at 2 separate banks here, actually several, but the 2 main ones we're looking at are Bank of America with Michael Widmer and BMO. Michael Widmer is the head of research for Bank of America. He came out, he's calling for $6,000 gold in Q1, right, by springtime. Effectively, that would be a 20% return by spring. He also highlights his projection is $8,000 gold in 2027. The reason Bank of America and Widmer highlight this and project this is twofold: falling rates, but also falling supply. Gold supply is expected to actually shrink by 2% this year. Meanwhile, investment demand right now is up 15%. Okay. Now, you look at JP Morgan Chase, the last 3 years in a row, they've predicted gold as the top performer. This year's no different. They're projecting gold to move above $6,300 this year. So a little bit more modest than Widmer, but again, still looking at $6,300, you're looking at 23+%. UBS, Deutsche Bank, all project over $6,000 gold with the potential to rise to $6,900 this year. And then on the side of it, you have BMO. BMO's projecting $8,650 gold by the end of 27. So this would be over 18 months. And the main thing that they're highlighting is what we were just talking about, the shift back to mercantile banking. The direct quote from them was, the global order and financial system are undergoing a scale of disruption that has not been seen since after World War II. And you can see right there that shift back to mercantile banking. Richard, I see the mention about safety and gold deposits. Just before we get into the chart, I'll handle that. First things first, there's a primary difference between a safe deposit box and a secure depository like an IDS or a DDSC and this type of thing. First off, safe deposit boxes at the bank, they're not FDIC insured, and they are fully reportable. Not saying that your IRA is not. The IRS has reports from your IRA, but IDS and DDSC, but mainly IDS, Texas, and Delaware, they sit outside the financial system for all purposes. If you were to have an account there outside your IRA, that is a truly outside financial system depository. They do not report to anyone except the account holder, and in this case, the institution Advanta that holds the account. Their primary setup to protect you here is the all-risk insurance from Lloyd's of London. First things first, I would say it's extremely unlikely that ever happens again. We have to remember that at the time of confiscation, there was the gold standard still. This was the end of the gold standard, but the currency was backed by gold, which is why they were collecting the gold. We are not in a similar position now. But if that were to happen at IDS Texas, your all-risk insurance would cover your metals. You would have the option to either have them replaced, or if that was not feasible, you would get cash value for your metals. Great question. Now, I want to show a couple charts here just on gold. This chart here you'll see is showing a triangle target. It's referred to as a triangle pattern or a pennant pattern as well. This is an uplifting triangle, or rather a slanted upwards triangle. And what you'll notice in this period of consolidation, we saw a high of $5,600 gold. Now, I do want to emphasize the reason we saw gold and silver surge so much like this was twofold. The markets were counting on a rate cut in January, which was unfounded and they did not get. The other thing that I do want to emphasize here in gold is, despite the retracement of 5,600 down to 4,400, gold was still up over 14% in the month. This was a healthy correction. Okay. Effectively, what's just happened in gold and silver are both moving in waves right now, right? The theories that would apply to this are Elliott wave and the Fibonacci extension. Gold's moves until now have been $900 up, $300 back. Effectively, it's a 38.2% retracement. Okay. What's happened here is we just saw gold move up by well over $1,600. The retracement in gold was exactly 38.2% of the total gain. And so what I mean to say by that, in Elliott wave theory, there are A wave, B wave, C wave, D wave, E wave, 5 waves, okay? So far in gold, we've seen 3 of them. The last wave we just have was wave C. The waves remaining of what's coming after consolidation are going to be waves D and waves E. What will follow this triangle pattern is wave D. And so what happens in a pennant pattern or a triangle pattern like this, as you consolidate, your highs and lows get tighter and tighter and tighter. What happens when your highs and lows get tighter and meet a converging point at the end that forms a triangle is it's like taking a coil and compressing it down in your finger. As they get to their tightest point, right, in your fingers, they blow off. It's like letting go of the coil or the spring and it explodes. When you're looking at this, the explosion points at the tip here will be resuming the wave theory, right? We will be in D wave. And the current prediction you'll see is between $5,900 and $6,200 for the end of this wave, putting it right in line with Bank of America's target of $6,000 this quarter. Now, moving on, we know what's happening with gold. We just talked about it. What are we looking to happen in silver? Same research analyst, Michael Widmer, his projections are for silver to reach between $135 and $155 an ounce in 2026. He additionally projects a possibility for silver to ultimately reach $309 in this overall rally. That's not this year, most likely not next year either. We're talking out 29 and past. And so the major thing that you see from Widmer, is his direct quote is, silver will appeal to investors willing to take more risk for extra upside, as the gold to silver ratio, which is currently today at 59, suggests silver could still outperform gold. Now, when we look at BMO as well, the other bank we've been tracking here, their projection for silver is about $5 more than Widmer. They're calling for $160 silver in 2026. They're calling for $220 silver by Q4 of 2027. The major thing that they highlight again is the gold to silver ratio. They think now that the gold to silver ratio has collapsed, it will stick within the 40 to 50 to 1 range, and that will carry silver ultimately to $220. When we talk about gold and silver and how do they come up with price projections, they follow the dollar to project the price of gold. The price of silver's projections are sheerly derived off taking the average ratio, dividing them, and that gives us the silver price. Silver doesn't do anything without gold. Okay, so that's one thing I want to harp on. When they talk about silver facing a little more risk, they're talking about volatility. Okay, gold is typically steady Eddie. If you want to do nothing but beat inflation and you're still going to get great returns, that's gold for you. If you want to have peak capital appreciation, but you're okay with more volatility, that's where silver comes in. And that's primarily what he's referencing him here. And the big thing you'll see is that gold and silver, they reference the Sell America trade. The reason they're referencing that is the whole trade for gold and silver is based on the devaluation of the dollar. Now, showing you a couple charts here on silver, right? One thing I wanted to emphasize, silver is also moving in waves, just like gold. And funny enough, to fit Elliott wave theory, the contraction that we just saw in silver was exactly the same as gold, 38.2% of the total upwards move. Silver has now completed wave C. The first 2 waves were $16 up, $5 or $6 back, right? 2 steps forward, half a step back, and then move on. This last wave saw silver move up by $70 in a single move. The contraction brought us back below $100. the major thing that you'll see, you look on the right-hand side of this chart and you see gold 4,400 in a blue line. The reason that's drawn across there is because silver found its bottom when gold found its bottom. Silver bottomed at $70, roughly speaking, which we looked at as the buying opportunity of the century here, because it's going back exactly to where it just was. The beauty of that was, if you look at this, gold today is at 5,000, right? It's moved from 4,400 up to 5,000. And it's the exact same reason it's brought silver with it. Silver today has moved from 70, it moved back up to $86. And so since finding the bottom, both gold and silver, gold moved roughly 15%, silver moved well over 20% here. Now, moving on here, and another thing I wanted to emphasize in the bottom left hand of this silver chart is when we looked at the dollar, we saw a death cross where the moving averages converged downwards. The opposite is true in silver. Over a year ago, we saw that 50 come up through the 200. That is referred to as a golden cross. Again, one of the most bullish signals you can see in any market. And the key thing that you'll notice is that blue line all the way across the chart has never come back even close to the red line. It has not changed. And so overall in the silver market, we know we're positioned well with gold. We know gold is moving up, which means silver is moving up as well. We also have multiple signals such as a cup and handle and a golden cross that tell us exactly what we should be doing with our money, and that's buying silver. Now, the gold to silver ratio, and I don't see my text coming up here on the screen that I have for the slide, so I apologize. But today, right this second, the ratio is 61 to 1, this very second. If you look at it all time, the average ratio is 53 to 1. Now, for anyone watching this, if you have a question on how do you calculate it, it's real simple. You take the price of gold, you divide it by the price of silver, that gives you the ratio. It's how many ounces of silver you could buy for every ounce of gold. The average is 53 to 1. Right now, we're slightly more extended. We're 61 to 1. But again, this has closed dramatically from where it was just 90 days ago, okay? And one thing we do know, if the ratio gets to 80 to 1, silver typically makes 4%, 4.5% rather, for every 1% gold makes. Now, just to illustrate that, I wanted to show everybody, if you look since April of last year, we talk about silver outperforming gold last year, right? Silver did double the returns that gold did. The big thing here was investors coming in and seeing value in silver. You'll see the ratio close from over 100 to 1, which is a high, right? That's happened twice before in history. And it closed all the way down to a low of about 46 to 1 at the all low there. So effectively here, what I'm trying to show is the main reason for silver catapulting so much more than gold is the fact that this ratio is closing. If we look at the average ratio being 53 to 1, we would still be correct to say that in the 60s, silver is a good buy right now. But at the same time, if your objectives are stability, your objectives are just matching inflation, gold's not going to be a bad buy for you either at this point in time. Now, just quickly before we wrap, because I know we're under the gun here, Scott, is I just wanted to show here, this is a study over 50 years showing portfolio allocation. You'll see this is done by the CPM group. From 2018 to 1968, they said portfolios allocated for all conditions that had 25% precious metals, 75% when they refer to other investments, they mean S&P T-bills. That produced actually the top returns, on average 9.2% a year over 50 years. An aggressive investor, they still showed with a 10% allocation, and they deemed that someone with 6 streams of income. And Ray Dalio, the founder of Bridgewater, the largest hedge fund in the world, he himself personally holds 7.5% allocation in precious metals. Now, what you'll see is lately, major banks, Bank of America, Goldman Sachs, the last 2 years, they've actually said not 20, not 25. They're saying ditch 40% bonds, buy precious metals because it'll outperform the bonds significantly here. The big reason they're saying that is, like we're talking about with rates being cut and yields falling, yields have not fallen to this level quite yet. If we look at what just happened in Japan very recently, similar to what happened in the UK, their bond rates stayed stubborn through multiple cuts. And after a handful of cuts, it's like the bond market, the bottom fell out from underneath it. The big thing that the major banks here are emphasizing is that in both cases of Bank of America and Goldman, the safety feature of bonds has been taken away from us here because they're underperforming commodities across the board. And so they're emphasizing the idea that if you want protection, but you want to make the most money you can make, the best thing to do in that scenario is gold and silver. They do recommend other commodities. Don't get me wrong. Morgan Stanley is recommending 60-20-20, 20% metals, 20% oil and gas. The one thing I would state personally is oil and gas can traditionally be a fairly risky investment. And so if you're replacing bonds, you typically want to go with a safety or rather insurance policy, so to speak, like we were talking about with gold and silver. Now, moving on here, the big thing I wanted to show, this is again from the same CPM group study. What you'll see is investors that had more gold in their portfolio as opposed to stocks or bonds or other assets actually made more returns, right? The 70% allocation had quite a bit more than 25 to 30%. However, the reason that they highlighted 25 to 30% over 50 years was because of the fact that you're not missing out on potentially riskier opportunities, but higher returning short-term opportunities in the market elsewhere. Now, big thing that I wanted to emphasize here, again, thank you, Scott, for having us on. But the big thing for us is if you have any questions, any concerns, don't hesitate to reach out. Just because you called doesn't mean you're forced into a transaction or anything like that. If you just need, a bit of an education or an update, or you need help getting, a hold of what you've got or learning about it, give us a call. We're open every day from 9 a.m. to 8 p.m. Eastern. Our customer care center is located locally here in Florida as well. We're in Palm Beach on the other side of the state from Advanta. And I'll pop up here. What you'll see is we have the office number there and my direct email. What I would say is if you want to book a call, feel free to send me an email. I'm available anytime. Conversely, if you want to call in, that number goes to my wonderful ladies at the front, and they will be happy to make sure you get an appointment booking anytime you need.
All right. Thanks, Greg. Hey, I had a couple of questions come in. We'll get to them and try to wrap up here. One question I think I will take. Guillermo asked, if I hold gold in a Roth IRA and want to sell a few coins after retirement, do I have to pay taxes? And I'll address that kind of in two ways. One, simply selling your coins for cash back into your IRA or Roth IRA is not a taxable event. The taxable event occurs with IRAs when you pull money out of your IRA to yourself personally. If it is a Roth IRA, once you're over 59 and a half and you've had an account for 5 years, you will not have any tax consideration. That's the huge benefit that the Roth IRA does. In a regular IRA, if you take cash out in retirement, you are taxed at ordinary income at that time. But to answer your question, Guillermo, as long as you're over 59 and a half and you've had a Roth for 5 years, you're not going to have any tax consequence for selling the gold or then in turn taking that money out as a distribution. Greg, a question for you. Someone is asking, what is the premium you typically charge for gold or it says silver, but just maybe go over for gold or silver?
So again, it's going to be widely product-based, right? So the lowest premiums you're going to pay is on bullion products. If we're talking about gold bullion bars, 1 ounce, 10 ounce, kilo, shockingly enough, the 1 ounce right now are the cheapest. We're seeing premiums depending on the brand of mint you choose vary anywhere from 1.5% all the way up if you want specific mint, Carta de Sade, and all this other jazz. They could go up to 10%. Silver typically in premiums, we're looking anywhere from the neighborhood of 5% all the way up to 13, 14% depending on the product. Typically, when you're buying these products, and what I would advise is the larger bars that you buy, the cheaper the premium typically tends to be. And what I do want to emphasize too, when I speak of the premium I'm talking about is not just money going in our, in the pocket of us. We're trading on set premiums set by Dylan Gage, the purchaser for the mint, across the board. The biggest concern here when you're buying is not necessarily what you're paying for the product. It's actually the buyback. It's what's the difference between the bid and the ask. So we're trying to put people into products that have the thinnest possible spread between the bid and the ask overall.
All right, good. I don't look like we have any other questions. A number of comments out there we can leave there. Greg, obviously, thank you very much again for coming on today. If you're listening to us live or recording, grab Greg's information from this slide. Reach out to him with any questions you have or anything else you want to revisit from the webinar. Certainly, if you're watching the recording of this, you have this information to go through. If you need my information's here on this last slide. If you have questions on the IRA process, the requirements for metals inside of an IRA, although obviously Greg is well versed in those questions and can answer those questions as well for you. So, Greg, thank you again for coming on. Another great information that you shared with our guests today. We really appreciate you coming on and sharing your time today.
Thanks for having us again, Scott. Always love these and appreciate the opportunity.
All right, good deal. All right, thank you everybody for attending and for listening live, listening to the recording, and we'll catch you in our next event.